Hello friends, welcome to day 5 of marathon. So today we'll be completing the discussion on direct taxes. So we'll be completing we'll complete the discussion on direct taxes today, and maybe from Monday onwards we will do indirect taxes. Indirect taxes I'll not take much time because it is very simple and easy to understand. Indirect taxes will be starting from Monday. Okay. So the remaining topics, leftover topics, small topics are there. Hardly 1.5 hours will complete this discussion, or 2 hours maybe maximum. Will complete this discussion. What is this point, sir? Clubbing of income. You can sit, no problem. No problem. Income of other persons included in assessee's total income. What is this point telling, sir? This point talks about clubbing of income. This point talks about what, sir? Clubbing of income. Clubbing of income means what, sir? So whatever income someone else is earning, that will be clubbed in your hands. It will be mixed or clubbed in your hands, and you will have to pay taxes on those income. So that is this clubbing of income. Yes, sir. Now there are different sections in this clubbing of income. Let me do one thing. Okay, I'll just explain it through the classroom material only. Yeah. So section 60 talks about what's the section 60 talks about transfer of an asset. If you are transferring an income without transfer of asset, then whatever income you have transferred to whomever you have transferred, that will be clubbed in the hands of the transferee. If you are transferring an income without transferring an asset, for example, I had an FD worth rupees 10 lakhs, which is giving me an interest of 10,000 rupees. I transferred it to my brother's son. Now that whatever interest is there, that is though received by my brother's son, it will be taxable and clubbed in my hands. Then section 61 talks about revocable transfer. What is revocable transfer? I am transferring an asset with a condition that I am going to take back these assets on a future date. So though asset is transferred to someone in his name, but I am a person who can take back this asset from that person on a future date. So this type of transfer is called as revocable transfer. In case of revocable transfer, on the transferred asset, any income which is derived, though the income is earned by that person in whose name you have transferred the asset, that income will be clubbed in your hands and you are going to pay the taxes. Exceptions are there for this. If it is an irrevocable transfer, then this condition is not applicable. What do you mean by irrevocable transfer, sir? I am transferring with a condition that I will not take back this asset at all from you. Or if transfer is with a condition that it will be revoked upon the death of the transferee. For example, I have transferred the asset to someone telling that, see, if you die, then I'll take back it from you, or else I'll not take it back from you. So in that case, what will happen, sir? This is a type of revocable transfer upon death of the transferee. It will get revoked on which date? It will get revoked on the date of the transferee. Then irrevocable transfer, if transfer is with a condition ... Asset transferred to a spouse or son's wife. If you are transferring an asset to spouse or son's wife, then what will happen, sir? Spouse means say in my case my wife, and in wife's case husband, etc. Son's wife is daughter-in-law. So if I transfer anything to my wife, now please note, whatever example I'm going to give with respect to my wife, but equal provisions are applicable to whom, sir? Daughter-in-law or son's wife. Now let us say I transferred a car to my wife. My wife gave this car on rent and she earned a rental income of 1 lakh rupees. This income will be taxable and it will be clubbed and taxable in my hands. Then case number 2, I gave shares of Reliance Industries worth 10 lakh rupees to my wife. She earned a dividend. This dividend will be clubbed in my hands. She sold the shares and earned a capital gain. This capital gain will be clubbed in my hands. So if I transfer any asset to a spouse, whatever income is generated on the transferred asset, that will be taxable in the hands of the transferee. It will be taxable in whose hands, sir? In the hands of the transferee. Similarly, I gave an FD to my spouse and my wife earned interest of 10 lakh rupees. Can I say this interest will be taxable in my hands? Yes, sir. Now what my wife did was, she closed the FD. After closing the FD, she purchased a new house worth rupees 1 crore, meaning 100 lakhs. Now she earned rental income from this house. Is this rental income also clubbed in my hands? Answer is yes. Answer is what, sir? Yes, lawmaker says, irrespective of how these assets are, whatever transferred asset is there, if it is changed, if that is changed, the transferred asset is changed, then also clubbing provisions will apply. Then I'm giving an FD worth rupees 10 lakhs. My wife closed the FD and she got 100 lakh rupees, and she invested her own 50 lakh rupees, and with this 150 lakhs or 1.5 crores she purchased a house from which she is earning a rental income of 6 lakh rupees. Now this rental income of 6 lakhs, will it be clubbed in my hands? Here the lawmaker says, I had transferred an asset worth rupees 100 lakh. So only with respect to 100 lakh, whatever income she is earning, that will be clubbed in my hands. What do you mean by this, sir? Now, though she has received 6 lakh rupees, in my hands, 6 lakhs into 100 divided by 150. Why, sir, 100 divided by 150? See, 150 is the total cost of the asset. 100 is the price which I have paid. So 100 divided by 150 will be clubbed in my hands, and balance will be taxable in whose hands, sir? My spouse's hands. Now, please note. This provision, clubbing provision, will not be applicable for accretion income. Meaning what, sir? It will not be applicable for income on income. For example, I gave shares of Reliance Industry. She earned a dividend worth rupees 1 lakh. Can I say dividend will be clubbed? She sold the shares and got a cap gain. Can I say cap gain will be clubbed? Now, this is the first generation of income. This is the income generated on the transferred asset. Now, this income which is there, no, this income, I have not received this income. This money was received by my wife only. But this money is taxed in my hands. I have not received this money, but it is taxed in my hands. Now, this money, if my wife purchases anything with this money, and if that asset is generating income, no, that will not be clubbed in my hands. Please note, the income from the transferred asset will be clubbed in my hands, irrespective of in which form the asset is getting converted. So I gave shares, she sold the shares and purchased a car, then she sold the car and purchased a house, etc. Irrespective of how the transferred asset is getting converted, it does not matter. It will be always clubbed in my hands. But whatever income is earned on the income which is already taxed will not be clubbed in the hands of assessor. For example, dividend income and cap gain income is already taxed in my hands. Now she earns any income from this. That income will be taxable in wife's hand and not my hand. Now please note one very important point. Marriage should exist at the time of transfer as well as at the time of receipt of income. If any individual, so what is the provision telling, sir? If any individual transfers any asset to his or her spouse without consideration or for inadequate consideration, the income from such asset shall be clubbed in the hands of the transferor. Marriage should exist at the time of transfer of asset as well as at the time of receipt of income. Now, this provision is not applicable in case of divorce and in case they both, husband and wife, agree to live apart. They both agree to stay away from each other. Now, sometimes what may happen is the asset which is transferred may be money, and that money may be invested in the business. For example, I have transferred, let us say, I gave rupees, let us take this example, I gave 10 lakh rupees to my spouse. Now, what did my spouse do, sir? My spouse, with this 10 lakh rupees, she added her own 20 lakh rupees and she took my 10 lakh rupees from me. With this 30 lakh rupees, she started her own business. She took 10 lakh rupees from me and she had her own 20 lakh rupees. With this 30 lakh rupees, she started business. Now, business earned a profit of 9 lakh rupees. Now, what will happen to this profit, sir? What will happen to this profit? Will it be clubbed in my hands? See, business was started by her. All the hard work she is only putting. I had just given 10 lakh rupees. Will it be clubbed, sir? Lawmaker says yes. Lawmaker says 9 lakhs into 10 divided by 30 will go to whom, sir? 3 lakh rupees will be clubbed in my hands and balance will be taxable in the hands of my spouse. So this is one important point. So even if the money is invested in the business, it will be clubbed, provided there is a condition. Whatever money I have given, no, that should be there in the opening capital. It should be there in the capital as on the first day of the previous year. Meaning if the money, I say for example, I transferred the money to her on 10th of April 24. Correct. Now she earned an income in the year 24-25 of rupees 9 lakhs. Will this income be taxable in my, will it be clubbed, sir, in my hands? Answer is no. Whatever money is transferred by me, that should be there on the in the opening capital. For example, if I would have transferred the money on 30th March 2024, then on 1st of April 2024, can I say my money is also there in her business? Now whatever income she's earning in 24-25 will be clubbed in my hands. Okay, so it should be there in the opening capital. Then yeah, income of spouse from a concern where the assessee is having substantial interest. So if the assessee is having any substantial interest in any company, okay, let us say there is Akshay Kumar who has substantial interest in Dharma Production. So concern means what, sir? That concern can be anything, can be a partnership firm, company, LLP, OPBI. So if you have substantial interest in any concern, and if that concern is paying remuneration to your spouse, that concern is paying remuneration to your spouse, even though that spouse does not have any technical or professional qualification, meaning my spouse is not having any professional or technical qualification, but the company in which I have substantial interest is paying some money to my spouse. Lawmaker says, why is the company paying? Even when your wife is not qualified, when she is not having any professional or technical qualification, why is the concern paying your wife? There may be some mistake happening over here, there may be some fraudulent activity happening over here. So what lawmaker says here is, in this case, this income will be clubbed in my hands. So if Akshay Kumar has substantial interest in Dharma Production, and Dharma Production is giving money to Akshay Kumar's wife worth rupees 10 lakhs, she has no professional technical qualification, therefore this income, though received by wife, it will be clubbed in the hands of Akshay Kumar. Now please note, what do you mean by substantial interest? Substantial interest means you should have 20% or more voting rights or profit sharing ratio or equity shareholding. You have 20% or more voting right, profit sharing ratio or equity shareholding. Sir, now substantial interest, should it be seen of the assessee only? No. Substantial interest should be of the assessee, and you can also include, even if the relatives have invested some money, you can also include the holdings of relatives. So substantial interest should be seen of assessee and his relative. Relative here is spouse, brother, sister, lenient antecedent and lenient decedent. Sir, my question to you is, sir, what if Akshay Kumar has 12% stake and wife also has 12% stake? Sir, in this case, Akshay Kumar will also be having 24% stake and a wife will be having 24%. No, sir. Sir, in this case, can I say both are having substantial interest, sir? Yes, yes, correct. You are absolutely right. Sir, when both are having substantial interest, what will happen, sir? What will happen? Now, if both are having substantial interest, now we will see who does not have professional technical qualification. If husband has professional qualification, but if wife does not have professional qualification, whatever is paid to wife will be clubbed in the hands of husband. Similarly, if husband does not have professional qualification, but wife has professional tax qualification, whatever remuneration is paid to wife will be clubbed in the hands of whatever amount is paid to husband will be clubbed in the hands of wife. Sir, what if they both have substantial interest in a concern and they both don't have any professional technical qualification and remuneration is paid by the concern to both of them? In that case, what will you do? In that case, lawmaker says clubbing shall happen in the hands of that assessee whose clubbing shall happen in the hands of that assessees whose total income is more before clubbing the income received from that concern. Any income other than that income, that particular income, whosoever income is more before clubbing this income, in that person's hand it will be clubbed. So in that case, clubbed in the hands of the assessee whose total income is higher before clubbing this income. Sir, what if they both don't have any income at all? Sir, what if this is the only income which they are earning? This is the only income which they are earning and they are both not having any other type of income. In such cases, tell me, sir, what is going to happen? In such cases, lawmaker says, if both the spouses have substantial interest in the concern and both of them are receiving remuneration from the concern, and if both of them do not have any professional or technical qualification, clubbing shall be happening in the hands of that assessee. Clubbing provision shall not apply at all. If both of them are having substantial interest and if both of them do not have any professional technical qualification, no clubbing. Section 64(1) capital A talks about income of minor child. So any income earned by a minor child shall be clubbed in the hands of his or her parents. So whatever income a minor child is earning, it shall be clubbed in the hands of the parents of minor child. Which parents, sir? The clubbing, it shall be clubbed with the hands of parent whose total income is higher before clubbing this income. So before this clubbing this particular income, whosever income is more in that person's hand, it will be clubbed. Once income is clubbed in the hands of any one of the parent in a previous year, then in all the subsequent years, clubbing will happen in the hands of same parent. So if you are clubbing the income in the hands of one particular parent, in all the future years it will be clubbed in the hands of same parent. However, there is some exception. If the minor child is earning income by way of skill and talent, by way of manual work, or if the minor child is an ATU disabled minor child, in these three cases, whatever income is earned by minor child shall not be clubbed. Sir, which cases, sir? If minor child is earning any income by way of his own skill and talent, or his own manual work, or he is a ATU disabled minor child, then no clubbing shall apply. Section 1032, exemption will be given. Now, we understood that minor child income will be clubbed in the hands of that parent who has a higher total income, and once the clubbing happens in hands of any parent, on all the future years the clubbing will happen in the hands of same parent. Now the minor child, the parent in whose hands the minor child income is getting clubbed, that parent will get what, sir? That parent will get an exemption up to 1,500 per annum per minor child, irrespective of number of children. So that parent will get what, sir? Exemption. Meaning, if the income earned by the minor child in a year is 10,000 rupees, parents' hands how much will be taxable after exemption? 8,500 only will be taxable. Note number 1. Minor child over here includes whom, sir? Minor child over here includes minor married daughter and minor married son also. It will include minor married daughter and minor married son. Minor child over here will include your own child or your legally adopted child, or what, sir? A minor over here will include your own child, legally adopted child, or your stepchild. Sir, what will happen in case of divorce of parents? In case of divorce of parents, it will be clubbed in the hands of that parent who is maintaining the child. Who is what, sir? Maintaining the child. Now, there is one more concept called as cross transfer. What is this cross transfer, sir? Cross transfer means, let us say two friends are there, A and B. Okay, A has wife Mrs. A and Mrs. B. Now, both A and B knows that if A transfers anything to his wife, that income will be clubbed in the hands of A, and whatever B is transferring to wife, that income will be clubbed in the hands of B. So what they do is they come into an arrangement wherein A tells B, hey B, I will transfer some assets to your wife, you transfer some assets to my wife. Whatever income is there now, so it will not get clubbed, no, because we are not at all related. A says, I will transfer something to your wife. Let us say asset worth rupees 10 lakhs, I will transfer to your wife. You transfer whatever amount you want to transfer, you transfer it to my spouse. So he transfers assets worth rupees 8 lakh. Now, from this asset, no, they are earning an interest of 80,000 rupees and 1 lakh rupees. Now, the question is, the income is earned by A's wife and the income is earned by B's wife. So, the question is, sir, here will the clubbing provision apply? Lawmaker says this is a case of cross transfer. Lawmaker says this is a case of cross transfer. Here, clubbing provisions will apply. How much income will be clubbed? 80,000 rupees worth income will be clubbed, meaning whatever is the common income, meaning how much ever is the lowest income, no, that income will be clubbed in the hands of Mr. A and Mr. B. This is called as cross transfer. So there is this chart revision. I mean, you can just go through it. Next is what, sir? Set off and carry forward of losses. As I told you, see, very simple. Hardly we just started, 20 minutes back, and we have almost completed one beautiful chapter called as clubbing of income. Set off and carry forward, hardly 10-15 minutes. Set off and carry forward of losses, another important chapter. Sir, what is the set off and carry forward of losses? Set off means what, sir? Adjustment. Carry forward means what, sir? Taking something to future years. Set off means you are adjusting. What am I adjusting, sir? What am I setting off? You are setting off what, sir? Set off means adjustment of losses against income. Now there can be two types of set off. One is called as intra-head set off. Another one is called as inter-head set off. Sir, what is this inter-head set off and intra-head set off? Inter-head set off means loss of a particular head is adjusted or set off with income of the same head. Loss of one single particular head is adjusted or set off with the income of the same head. That is called as what, sir? Intra-head set off. Then what is inter-head set off? Loss of one head is adjusted with income of another head. For example, if loss of house property 1 is adjusted with profit of house property 2, that is called as intra-head set off. Say, or case number 2, if salary is setting off house property loss, that is called as inter-head set off. Okay. Next, what is carry forward and set off? See, normally, if your current year losses are not able to be fully adjusted with current year income, if you are not able to fully adjust the current year loss with the current year income, then that unadjusted loss will be there now of current year, that will be taken to future years and it will be adjusted in future years. If current year losses cannot be fully or completely adjusted with current year income, then such unadjusted losses will be carried forwarded and adjusted in subsequent years. Now let us learn about intra-head set off or intra-head adjustment. Intra-head means what, sir? Same. Income from salary. So we'll talk about all the 5 different heads of income and whether that intra-head means what, sir? They can set off with themselves or not. Income from salary. See, normally loss under the head salary is not possible. It will never happen that you are working somewhere and you are giving money to that person only. Correct? Or loss under the head salary is not possible. Therefore, no intra-head set off is applicable. So in case of salary, the concept of intra-head set off will not be applicable. Then house property. House property, can I set off loss of one house property with income of another house property? Yes, we have also done that particular thing in our previous. In our previous. If you see the previous topics which we have discussed, we have already done that. We have already seen that if there is a loss of one house property, can I set off with income of another house property, sir? Answer is 100% yes. Intra-head adjustment of loss from one house property can be done with income from another house property. So there is no restriction. Sir, what about business income, sir? Now, for the purpose of set off and carry forward, your business income is divided into 3 categories. One is called as your normal business, another one is your speculation business, and third one is your specified business. Sir, what is this normal business, speculation business, specified business? Let us say normal business means all the businesses. Normal business means what, sir? All the businesses other than speculation business and specified business. Meaning, normally whatever businesses you are seeing in your daily life, when you are going out of your house for a walk, you see different shops are there. When you are going on a vacation, you see different shops are there, different companies are there. They are all doing normal type of business. Now, what is speculation business then? Speculation business means you are buying and selling shares without taking its actual delivery. What is speculation, sir? You are buying the shares, selling the shares without taking the actual delivery of the shares. Then it is said that you are doing speculation. Sir, then what is specified business? Specified business means those 35 AD business. Specified business, 35 AD, 14 businesses are there. Honey business, sugar business, then hotel business, hospital business. Correct. So those are the specified business. Now what is the provision with respect to intra-head adjustment telling, sir? What does it say? Your normal business loss can be adjusted with any type of business income. So whatever loss you are incurring in normal business, that can be adjusted with other normal businesses, as well as you can adjust it with specified business as well as speculation business. Meaning your normal business loss can be adjusted with any type of business income. Sir, what about speculation business loss? If you are making any loss in speculation business, that speculation business loss can be adjusted only with speculation business income. Speculation business loss can be adjusted only with speculation business income. Sir, what about 35 AD or specified business loss? Your 35 AD or specified business loss can be adjusted only with 35 AD business income. So what's our repeat, sir? Normal business loss can be adjusted with any business income. Speculation only with speculation. Specified only with specified. Sir, can I adjust normal with speculation? Yes. Can I adjust normal with specified? Yes. Normal can be adjusted with any type of business income. Then we have capital gain. In capital gain, the set off is little important. Long-term capital gain, capital loss can be adjusted only with long-term capital gain. So if you have a long-term capital loss, then that long-term capital loss you can adjust it. You can set off it only with long-term capital gain. Similarly, short-term capital loss, if you have, that short-term capital loss can be adjusted either with long-term capital gain or short-term capital gain. Then your which income, sir? Income from other sources. See, normally loss under other sources is normally not possible, but in some cases it may be there. So if you have loss of exempt income, if you have loss of any exempt income, then that can never be adjusted with anyone. If you have loss of casual income, then that casual income loss also cannot be adjusted. Similarly, your exempt income and casual income cannot adjust any other type of losses also. See, loss of exempt income, loss of casual income cannot be adjusted with others. Similarly, other people losses cannot be adjusted with them. However, if you have loss from owning and maintaining racehorse business, please note, horse race is gambling, casual income. Race horse is different. Owning and maintaining race horse means you are doing the business of maintaining the horses which are used in the race. So loss from owning and maintaining race horse, losses under this head can be adjusted only with income under this head. So loss under owning and maintaining of race horse can be adjusted only with income of owning and maintaining race horse. Then any other loss under income from other sources. Set off of losses under income from other sources can be done with other taxable income. So you can do, if there is any other loss apart from which loss, sir? Apart from exempt income loss and casual income loss, if you have any other type of loss that you can adjust with income, any other type of loss under income from other sources that can be adjusted with other taxable income of other sources. This was intra-head adjustment. Now we will see what, sir? We will see inter-head adjustment. Sir, what is inter-head adjustment? Inter-head means one with another. Section 71, inter-head adjustment or inter-head set off. What is inter-head? House property you are adjusting with business. Can you do so? We'll see. Income from salary. See, loss of any head can be adjusted with income of salary except the business and profession loss. Meaning your salary income is there, no? That salary income's loss can be adjusted. That salary income is there, no? That salary income can adjust any other head's loss except business. So if you have any business loss, can you adjust with salary income? Answer is no. Then income from house property. Loss of any head can be adjusted or set off with income from house property. If you have loss under any head, that loss can be adjusted by you or set off by you against income from house property. Meaning all the other type of losses, can it be adjusted with house property? Answer is yes. However, house property loss can be adjusted with other incomes only to a maximum extent of 2 lakh rupees. See, house property will take care of everybody's problem. But when it comes to house property's problem, will others take care? Yes, others will take care of house property's problem. How much? Maximum 2 lakh rupees. So house property's loss can be adjusted with other income. How much can be adjusted, sir? Maximum 2 lakh rupees can be adjusted. Then income from business or profession. Loss of any head can be adjusted or set off with income from business or profession. So if you have loss under any of the head, house property or other sources or etc., that loss can be adjusted with income of business or profession. Business and profession loss also can be adjusted with any head except salary.
Whatever loss you have under your business can be adjusted only with all the other heads except salary. Now please note, very important point to be noted, speculation business loss and specified business loss can be adjusted only with speculation business income and specified business income. So if you have speculation business loss, it can be adjusted with speculation business income. If you have specified business loss, it can be adjusted with specified business income. Income from capital gain. Now please note, very important point to be noted, losses of capital gain cannot be adjusted with anyone. Losses of capital gain cannot be adjusted with any other head of income. Losses of capital gain can never be adjusted with income of any other head. Loss under the head capital gain cannot be set off or adjusted with income of loss of the head capital gain can be adjusted only with income of capital gain. However, loss of capital gain can be adjusted only with income of capital gain. However, loss under the head capital gain cannot be adjusted with income of any other head. So other people's loss will capital gain take care? Yes. Capital gains losses will other people take care? Income from other sources. Loss of any head can be adjusted or set off with income from other sources. So any type of losses can be adjusted with income from other sources. Loss under other sources can be adjusted with any income except exempt income losses and except losses of casual income. Meaning what, sir? See, other sources losses can I adjust with others? Yes. Others losses can I adjust with other sources? Yes. But loss from any exempt income, loss from any casual income cannot be adjusted with any other type of income, including exempt and casual incomes. Now, unadjusted loss of any head can be carried forwarded to the subsequent years except loss from other sources. Now, normally what happens is whatever your unadjusted loss is there of current year, that can be taken by you for the next year. It can be carried forwarded to the next year. Correct. So normally whatever loss you have in the current year, that can be taken or carried forward to the future years except other sources loss. The losses under the head other sources cannot be carried forwarded. The losses under the head other sources cannot be carried forwarded. Now, carry forward and set off of losses. Now we understood adjustment, meaning setting off of the losses in the same year. Now we are talking about carry forwarding these losses to the future years and adjusting in that year. Unadjusted losses can be carried forwarded to future years for adjustment against the income of those years. So if you have any unadjusted losses of any year, that can be carried forwarded by you and adjusted by you against the losses against the incomes of future years. Losses under any head of current year can be adjusted with income of any other head of the current year. Meaning what, sir? Normally, if you have loss under any head in this year, you can adjust that with income of other heads under the same year. However, once any loss is carry forwarded, once any loss is carry forwarded, then such carried forwarded loss can be adjusted only with income from same head in subsequent year. Sir, repeat. Once you have carry forwarded any losses, current year you were not able to adjust any losses, you have taken that loss to future years. Once you take any loss to the future years, you can adjust that only with the same head of income. You can adjust it only with whom, sir? Same head of income. If current year house property loss is carry forwarded, then in subsequent year it can be adjusted only with house property income. Now let us see the provisions with to set off. Can I carry forward house property loss, sir? Yes. Once I carry forward in future year, with whom can I adjust it? You can adjust it with house property income only. For how many years can I carry forward these losses? For 8 years. Now normally we call this return as income tax return. Correct? We file a return called as income tax return. Sir, what if I am making a loss, sir? Should I also file loss return? Lawmaker says yes. In some cases you will have to file loss return if you want to carry forward the losses. So filing of house property, in case of house property loss, is loss return filing mandatory? Answer is no. Normal business income, normal business income loss can be carry forwarded. Normal business loss can be carry forwarded for 8 number years and can be adjusted with any business income. Any business, a normal business loss can be carry forwarded with and adjusted with any business income, and it can be carry forwarded for 8 years. And filing of loss return, is it mandatory, sir? Answer is yes. Similarly, speculation business loss, it can be carry forwarded for future years and can be adjusted only with speculation business income. How many years can I carry forward? For 8 years. And filing of loss return, is it mandatory, sir? Yes. Specified business or 35 AD business loss can be carry forwarded for future year and adjusted only with specified business income. For how many years can I carry forward, sir? There is no limit. You can carry forward for indefinite period. And to carry forward this loss, you will have to file loss return. Then, long-term capital loss can be carry forwarded and adjusted with long-term capital gain. It can be carry forwarded for how many years, sir? For 8 years. And filing of loss return to carry forward the losses, is it mandatory? Yes. Short-term capital loss can also be carry forwarded for 8 years and it can be adjusted in future with short-term capital gain and long-term capital gain. Filing of loss return is mandatory in this case also. 74A, owning and maintaining racehorse. Owning and maintaining racehorse loss can be carry forwarded and adjusted with whom, sir? Owning and maintaining racehorse income. It can be carry forwarded for 4 years and filing loss return is mandatory. Unabsorbed depreciation, that can also be carry forwarded. There is no limit for how many years you can carry forward, and filing of loss return for this is not mandatory. It can be adjusted once you carry forward unabsorbed depreciation. No, that unabsorbed depreciation can be adjusted with any type of income in future years. Now this is your set off in carry forward chapter. What is the order of set off? First you should solve your own house problem, then you should solve the problem of other houses. Meaning first you should do intra-head set off, then you should do inter-head set off. Order of set off of business loss. First you should always do adjustment of current year and then you should do brought forward adjustment. And current year also, first you should adjust current year business loss, then current year depreciation, then brought forward business loss and brought forward depreciation, etc. Now, current year losses should first be adjusted with current year income, and after that the brought forward losses can be adjusted with current year income. So whatever current year losses are there, you should first adjust them against all the different types of income under current year. After that only whatever unadjusted loss is there, no, sorry, whatever income is remaining, no, that can adjust the brought forward losses from previous year. Brought forward business loss can be set off even if the business is discontinued. No business, even if the business is not continued by you, you can still carry forward and adjust the losses. No loss can be set off against undisclosed income. Undisclosed income, undisclosed income is there, no undisclosed income or deemed income, against them no losses can be set off. Yeah, so this is all about your intra-head set off and adjustment topic. Next is our which chapter, sir? Chapter name is deduction. Important chapter, nice chapter. Next chapter is called as what, sir? Deduction. Format for computation of total income. What is the format for computation of total income? Very important chapter. Around 2 to 4 marks this topic will come. All the 3 topics combined together, they may come for 8 marks. Okay, meaning they can either ask a separate question or they will be all clubbed with the total income question. Okay, how do I compute the income? Total income, sir. First I take the income from different heads. So first head is income from salary, then income from house property, income from business or profession, capital gain, income from other sources, clubbing of income, and set off and carry forward of losses. You take the income under all these different heads. Once you take the income under all these different heads, you will get something called as gross total income. From this gross total income, you subtract the deductions, you will get your total income. So first take income of all the heads, that will be called as gross total income. From that subtract deductions, that will be called as total income. Now, computation of total income. Computation of total income, so we did computation of tax on total income. We have understood in our first chapter that first we should compute the tax on the income taxable at special rates, then compute the tax on income taxable at slab rates. So whatever income is taxable at special rates, take the total, then income taxable at slab rate, whatever tax amount is coming. On that total, apply rebate if applicable. Whatever amount is there now, on that you apply surcharge if applicable, and then apply health and education cess if it is applicable. So this is the total amount of tax which you have to pay. From this, if you have any TDS credit, TCS credit, please subtract that, because that is a credit available with you that you don't have to pay so much amount of tax. You'll get some amount, and subtract advance tax if you have paid any. You'll get your net tax liability. Now we'll start deduction topic. See, deductions are important because from the gross total income, when you subtract deduction, then only you will get total income. So unless until you know what are the deductions which are required to be subtracted, you will not know how to compute total income. Now, deductions under chapter 6A is not available against following income. So against these incomes you cannot claim deductions. Which incomes are? Long-term capital gain under 112A, short-term capital gain under 111A, and casual income. Under these incomes you cannot claim deduction. So if your total income has only these incomes and deductions, you cannot claim deductions. Deduction under chapter 6 is available only if the assessee claims for such deduction. So just because you have invested your money somewhere, will you get the deduction? Answer is no. You will have to claim this deduction. Now there are different sections. Most important section in your deduction, most important, which is something which you should not miss at all: ATC, ATD, ATE, ATG, ATJJAA, QQB, RRB. No, not ATJJA, AT, ATC, ATD, ATE, ATG, ATTTA, and ATU. These are some deductions which you are never supposed to miss. These are the deductions which you are supposed to 100%. I mean, this is something which you should 100% know. Okay. Now we'll study one by one which are these deduction. Section 80C talks about what, sir? Section 80C talks about LIC premium, tuition fees, provident fund amount, principal, repayment of housing loan, etc. So income of an individual. So to whom is applicable, sir? ATC talks about if you are putting the money, if you are depositing the money in any of this, if you are taking life insurance policy, you will be paying premium. If you are paying your child's tuition fees, if you are paying, if you are depositing the money in provident fund account, if you are making principal, repayment of housing loan, etc. Now, to whom is section 80C applicable? Section 80C is applicable to an individual or an HUF. If you are an individual or an HUF, you can claim this benefit. Whether you are a resident or non-resident, it does not matter. Okay, the maximum amount of deduction which is allowed under 80C is 1,50,000 per annum. Now, there are different points in this. Let us one by one understand this point. So, LIC premium paid by you. So life insurance policy premium, if you are paying, if you are an individual and if you have taken policy for yourself, your spouse, or your children, and if case of HUF, if they have taken policy for the members of HUF, then these people can claim deduction. Deduction, how much can I claim, sir? Whatever premium you are paying or the limit specified in the law, whichever is less can be claimed as deduction by you. Whatever limit they have given or the premium which is paid by you, whichever is less. Sir, what do you mean by premium? See, when you take a policy, every year you will have to pay some money to the company, insurance company. That amount which you pay every month, every year, if half yearly, depending upon what you opt for, that amount is called as premium. So whatever premium you have paid or limit which is given in the law, whichever is less is the amount of deduction which you can claim. Sir, premium, though I understand what I am paying. What is this limit, sir? Limit is the maximum deduction which is allowed. Maximum amount of deduction allowed for LIC premium. In normal cases, if the policy is issued before 1st of April 2012, it will be 20% of sum assured. If the policy is issued on or after 1st of December 2012, you can claim a deduction of 10% of sum assured. Where the person with disability, if you are a person with disability, then the policy is issued by you before 1st of April 2012, then it is 20%. Meaning, if the policy is before 1st of April 2012, then it is 20%, whether you are a normal person or disabled person. But if the policy is after in the year 22-23 for disabled person 10%, and from 1st April 23 it is 15% of sum assured. Now policy. Dilip has following policies. Let us take an example. I took one policy in 2008, so it is before 2012, 2014 and 2019. 3 lakh, 5 lakhs and 10 lakhs. This is the sum assured. This is the sum assured, meaning this is the minimum guaranteed amount which I am going to get. Premium is 50,000, 75,000, 80,000. Now what is the limit, sir? For, see, the limit will be how much, sir? Limit will be 20% for policy issued before 2012, 20% of sum assured. Sum assured is 3 lakhs into 20% is 60,000. Then after 2012 it is 10%. So 5 lakhs into 10% is 50,000. 10 lakhs into 10% is 1 lakh rupees. Now how much is the deduction given? Either the premium amount or the limit, whichever is less. So in first case I'll get 50,000. Second case I'll get 50,000. Third case I'll get 80,000. So this is the deduction which I'm going to get. Totally how much eligible deduction is there? 1,80,000. But how much can I take maximum? Maximum limit over here is only 1,50,000 rupees. Now, with effect from 1st of April 2014. So this is not applicable for any policy taken before this date. If you have taken any policy on 1st of April 2014 or after 1st of April 2014, if any policy or policies are issued on or after 1st of April 2014, then the maximum amount of premium of a single policy or all such policy taken together should not exceed 5 lakh rupees in a year. What is this point telling? If you have taken any policy on or after 1st of April 2024, the maximum amount of premium which can be adjusted by you is how much, sir? 5 lakh rupees. The maximum amount of premium which you should pay should not exceed 5 lakh rupees. If it is more than 5 lakhs, then amount received at maturity will be disallowed. And anyways, you can maximum claim exemption of 1.5 lakh rupees only, even if it is more than 5 lakhs. So if the premium amount is more than the limit given above, 10% or 15% or 5 lakh, then then what, sir? Then the amount received on maturity of the policy holder will be fully taxable. So what is the reason why we are studying this limit 20%, 10%, 15%, 5 lakh, sir? Because if the premium paid by you is more than this limit which is given in the law, then whatever amount you receive at the time of maturity will be fully taxable. Exemption under section 10D. See, normally what will happen? Amount received on maturity of life insurance policy is exempt under section 10D. So whatever money you receive upon on the life insurance policy will be exempt under which section, sir? 10D. Now amount can be received by you upon maturity of the policy. The amount is received by policy holder, or policy holder has died, therefore nominee will receive the money. If nominee is receiving the money, whatever money is received by nominee is always exempt because the policy holder has died. However, if the policy holder does not die and if the policy get matured, then whatever amount is received by the policy holder will be taxable or exempt depending upon what was the premium paid by him. If the premium paid by him during the policy term is more than the limit specified, it is fully taxable. If the premium paid during the policy term is within the limit specified, then it is exempt under section 1010D. Public Provident Fund, PPF. If you are contributing money, if normal people like us who are not working anywhere, they cannot have employee provident fund, recognized provident fund, statutory provident fund. So we have a place to invest, what is that called, sir? That is called as PPF or public provident fund. Now what is this point telling, sir? What is this point telling? Contribution made by an individual for himself, his spouse, or his children, and by an HUF for the members of HUF will be exempt. Deduction under section 80C. How much is the deduction allowed, sir? Amount invested by you or the limit of 80C, whichever is less is the amount of deduction which will be given. Employee contribution to recognized provident for superannuation fund, recognized provident fund, which if you contribute the money to recognized fund, it will be allowed as deduction. Sir, what if I contribute to unrecognized provident fund? Deduction is not allowed. Principal repayment of housing loan. If you have taken any housing loan, then that housing loan will have what, sir? That housing loan will have principal and it will have interest. So whatever principal you are repaying for housing loan which is taken by you, that is allowed as deduction, provided that the housing loan should be house should be a residential house, loan should be taken for construction or purchase, and loan should be from bank or financial institution. Apart from that, other things which are covered under 80C are investment in national savings certificate, NABARD bond, senior citizen savings scheme, CLSS pension scheme, notified units of mutual fund, Sukanya Samriddhi account, fixed deposits, etc. Then tuition fees, maximum for 2 children you can claim the deduction, provided the education should happen in India and it should be a full-time education. Now please note, whatever school fees you are paying, in that only tuition fees component can be claimed as deduction. 80CCC. 80CCC talks about what, sir? Pension scheme of life insurance policy. So there are a lot of different types of pension scheme. Like previously we saw a pension scheme of which company, sir? A pension scheme of mutual fund or unit trust of India, that is covered under 80C. Now we are talking about pension scheme of any insurance company. If any insurance company is coming up with a pension scheme, and if you invest your money in that pension scheme, then whatever amount you have invested up to 1.5 lakhs will be allowed as deduction. Whatever amount you have invested up to 1.5 lakhs will be allowed as deduction. Individual, to whom is this applicable? To an individual contributing money to the pension scheme of life insurance corporation or any other insurance company. How much is the deduction? Up to 1,50,000 per annum. Then we have 80CCD, 80CCD, contribution to pension scheme of contribution to pension scheme of central government or Atal Pension Yojana or national pension scheme. Maximum deduction allowed is 80 under 80CCD is 1,50,000 per annum. Now here, contribution to 80CCD pension scheme can be done by government salaried employees, or it can be done by non-salaried individuals also. So for a salaried individual, whatever amount he is contributing, that will be exempt subject to a limit. So whatever contribution he has made, or 10% of his salary will be allowed as reduction. And for employer contribution, first whatever employer has contributed, that will be added to his salary, and then deduction will be allowed under section 80CCD 2. How much is deduction? Whatever contribution is made, or 14% of salary, whichever is less. Now, if you are other than salaried employee, if you are not a salaried employee, then for you the limit will be amount contributed by you or 20% of your gross total income, whichever is less, will be allowed as deduction. Okay, this is the deduction allowed for 80CCD. Now, there is a section called as 80CCE, which gives a limit, upper limit for combined contribution made in 80C, 80CCC, 80CCD1 should not be more than 1,50,000, which says what, sir? 80CCE says the total contribution made by you under 80C, 80CCC, 80CCD1 should not be more than 1.5 lakhs, meaning maximum deduction you are going to get for all these sections combined together is 1,50,000 per annum. However, if you have contributed money in 80CCD 1, then you will also get extra 50,000 benefit. Now there is something called as 80CC head, which is an Agnipath scheme which has been introduced by government. It is just like your 80CCD, but here the limit is 30% of salary instead of 10% of salary. Next, another important section: medical insurance, central government health scheme, preventive health checkup or medical treatment. 80D, medical insurance or health insurance premium. If you are paying health insurance or medical insurance premium, that will be allowed as deduction only if it is paid by any mode other than cash. Then if you are contributing money under central government health scheme, or you are doing any preventive health checkup or doing any medical treatment. If you are an individual, if you are doing it for self, spouse, dependent child or parents, it will be allowed. And for HF, it is allowed if you are for members of HF. Now, what is the limit under 80D, sir? If I am taking a policy for myself, my spouse and my dependent child, 25,000 is the limit. And if any one among us is senior citizen, then the limit will be doubled. It will be another 25,000. So total limit will be 50,000, provided any one of us should be senior citizen. Similarly, for parents, the limit is what's at 25,000. If any one of our parent is senior citizen or both of them are senior citizen, extra 25,000 will be added. So total deduction, if no one is senior citizen, 25, 25. See, please note here, me, my spouse, my children are treated as one category and parents are treated as separate category. If I am taking insurance for everyone, sir, I can claim how much? 50,000, provided no one is senior citizen. Sir, what if all are senior citizen? 1 lakh rupees. 25, 25 plus 25 plus 25, 1 lakh rupees. Sir, what if you guys are not senior citizen, parents are senior citizen? Hey, in simple words, wherever senior citizen is coming now, add 25,000. Add 25,000. Then, if you're doing medical treatment, if you're incurring medical treatment expenditure for whom, sir, of any senior citizen who does not have health insurance, then you can claim 50,000 rupees deduction under 80D. Then, if you're doing any preventive health checkup, up to 50,000 rupees you can claim for self, spouse, dependent child, and parent, and this is included in the limit of 25,000 or 50,000, whatever limit is there. 80DD. If your dependent is disabled, you can claim a deduction flat. You can claim if you are a resident individual, then your dependent relative can be spouse, children's father, mother, brother, sister, or in case of HF, members of HF, if any person is disabled, if they are disabled, in case of normal disability, you can claim a deduction of 75,000, and in case of severe disability, if the disability is 80% or more, you can claim 1,25,000 rupees. Now, this deduction is available only if such disabled person has not claimed deduction under section 80U for himself. Now, meaning what, sir? You can claim deduction for your dependent relative if that dependent relative has not claimed deduction for himself under section 80U. Section 80U talks about what, sir? If the assessee himself is disabled person, if the assessee himself is a disabled person, then in case of normal disability, he can claim 75,000 per annum as deduction. In case of severe disability, 1,25,000 can be claimed as deduction. Section 80DD(B), dependent is having any specified disease. Deduction for medical treatment of specified deceased. If you are a resident for yourself or your dependent relative, in case of HUF, for members of HUF, this section is applicable. Normal cases, 40,000 you can take the benefit. In some special cases, you can take the benefit of 1 lakh rupees. Now, how much is the deduction load? Please note, all this section is all useless. Okay, 80U is important. Actual expenses or limit of 1 lakh or 40,000 less whatever reimbursement is done by insurance company will be the amount of deduction allowed. Next we have is 80E, another important section. If you have taken any higher education loan for yourself, your children's or your dependent relative, then up to 1,50,000 rupees you can claim interest deduction. Up to 1,50,000 rupees, no, any amount of interest paid by you. Individual takes an education loan for higher education of himself, spouse or children. Interest paid will be allowed as deduction for 8 consecutive years from the year in which the assessee starts paying the interest. If an individual takes education loan for higher education of himself, spouse or children, interest paid by them will be allowed as deduction for 8 years continuously from the year in which he starts paying the interest. 80E, interest for housing loan. If an individual is paying interest for any housing loan, then he can claim a maximum reduction of 50,000 rupees. Useless section, you don't have to read it. Provided that loan is taken in which year, sir? A loan is given in 1617. The value of the property is less than 50 lakh rupees. Loan amount is less than 35 lakh rupees. 80EEA, interest for housing loan. If you are not covered under 80EE, you can take the benefit of this. And if you are paying any interest for housing loan, you can claim a deduction of 1,50,000. The loan should be from bank or financial institution. House properties should value should be up to 45 lakhs. Loan should be sanctioned in from 1st April 2019 to 31st of March 2022. And the assessee does not have any income, any other house other than this particular house. 80EEB is if you are taking any loan for electric vehicle. If you are an individual, if you are paying interest for purchase of electric vehicle, you can claim maximum deduction of 1,50,000. Loan should be from bank, financial institution, NBFC. Loan should be for the purpose of purchase of electric vehicle, and loan should be sanctioned between the period 1st April 2019 to 31st March 2023. 80G talks about donation. If you are any type of assessee and if you give donation to someone, then you can claim deduction. No limit is there, or limit based deduction is there. No limit, any amount of donation you have given, that can be any amount of donation given by you can be claimed as deduction. If you put the money in PM drought fund, you can claim deduction of 50% of amount contributed. So there is no limit in amount contributed, but whatever contribution you are making, 50% of that can be claimed as deduction. Then limit based is 100%. Limit based 100% means if you are donating to any type of central government fund, any type of prime minister funds, chief minister fund, or any fund where the name national is there, Swachh Bharat Fund, Clean Ganga Fund, Army Fund, or Zilla Parishad Fund, in these cases, whatever amount you are contributed, 100% can be allowed as deduction. Okay, any amount can be donated without any limit, and that deduction will be allowed. Limit based means what, sir? Meaning your contribution does not have a limit, but deduction which I am going to give you will be restricted. So there is here also 50% category and 100% category. 50% if the donation is for any minority or any trust, or if you're donating to any temple, mosque, church, or any housing accommodation. And in case of family planning and Indian company giving for Indian Olympics, they will get 100% deduction. So how much is the deduction, sir? Amount donated or 10% of adjusted total income. Now whatever amount you get over here, that into 50%, that into 100%, depending upon where you are contributing money. What is adjusted total income? Your gross total income minus all the deductions except the deduction under 80G will give you this adjusted total income. Now donation in kind is not covered over here. If you donate anything in cash for more than 2,000 rupees, then that is not allowed as deduction. Meaning donation should be not, if you are donating more than 2,000 rupees, it should be account pay check, account pay demand draft, or any other electronic clearing system. 80GG. So let us say you don't have a house property at the place where you are staying, and you are also not getting HRA from your employer. Then you can take the benefit under section 80GG. Rent paid for a house property. What is this point telling? An individual who is not getting HRA and who does not have house at the place of his employment and who is not claimed any self-occupied property benefit, then he can claim a deduction for rent of house property. What can he claim, sir? Under 80GGG, he can claim a deduction for rent of house property. How much deduction can he claim, sir? 5,000 rupees per month, or 25% of adjusted total income, or rent paid minus 10% of gross total income. Adjusted gross total income. What is adjusted gross total income? Your gross total income minus all the special rate income and all the deductions except 80GG deduction. If you now please note, you individual himself, his spouse, minor child, and HUF should not have house at the place where he is working, and he should submit a declaration in form 10BA about whatever rent he has paid. Now, if a person who is having business income, if he is donating money for scientific research, he can claim the deduction under section 35. But what if normal individuals give the money for scientific research? They can claim the deduction under 80GGA. Donation for scientific research or rural development. All type of assessee except the assessee who is having a business income, at the time of donation to scientific research, rural development, or poverty eradication, can claim 100% deduction of the donation. donation more than 2000 rupees should be made by any mode other than cash. Now, if I donate money to political party, I can claim deduction. If I donate money to political party or electoral trust, I can claim deduction under section 80 GGB if I'm an Indian company, and I can claim deduction under 80 GGC if I'm any person other than Indian company. Donation should be made by any mode other than cash. Even 1 rupee donation in cash is not allowed for political parties. And expenses incurred for donation to a political party is disallowed as a business expenses. It will not be treated as business expenses, but you can claim deduction over here. Then 80 JJAA, deduction for employment of new workmen. If you are adding a new employees in your company, then you can claim extra deduction apart from their salary. Any assessee engaged in the business whose books of accounts are subject to audit has a turnover more than 1 crore or 10 crores shall claim a deduction of 30% of additional employee cost incurred by him for a continuous period of 3 assessment year. Additional employee cost means emoluments paid to additional employee for existing business, the increase in total number of employee compared to the employees employed in the last day of the previous year. So you should see what was the number of employees in the last day of the last year, previous year, compare that with the last day of the current year. If there is any increase, whatever extra salary you are paying to these people will be 30% of that extra you can claim as deduction. If you're a new business, all the employees will be treated as all the employees which you have added during the year, you can claim extra 30% for them. Additional employee shall not include employee whose emoluments is not more than 25,000, employee who is employed for less than 240 days, and who does not participate in recognized provident fund. 80 TTA, very important section, because most of the students will do a mistake over here. Whenever they say in the question that there is an interest income from saving bank account, that income will be taxable under the head other sources, then you should claim a deduction under 80 TTA. Okay. Interest on saving account. Individual except in if you are an individual except senior citizen having an interest income from a saving bank account, it can be in a bank, post office, cooperative society, etc. Whatever interest is earned by you or limit of 10,000, whichever is less, can be claimed as deduction. 80 TTB, interest on deposits. So if you are a senior citizen having any type of deposit in the banks, etc., you can claim deduction of interest earned of 50,000, whichever is less. Then if you are earning any royalty income, if it is royalty for book, you can claim deduction under 80 QQB. If it is royalty for patent, you can claim deduction under 80 RRB. The limit, how much is the donation deduction, sir? 30% of 3 lakh rupees or royalty received, whichever is less. And in case of books also, if the value of the book is less than 15 lakhs, less than 15%, if the royalty received is less than 15% of book value, whatever royalty you have received, or 3 lakhs, whichever is less, if it is more than 15% of book value, calculate the royalty amount by taking the royalty to be equal to 15% of book value or 3 lakh rupees, whichever is less. Now, if you are receiving royalty for books which is sold in other countries also, then whatever amount you have received in convertible foreign currency shall be added over here. That is all about deductions chapter. Next is one more section is there related to deduction only. Section 10AA, very easy section. Tax holidays for whom, sir? Tax holidays for SEZ units. Any assessee who is engaged in manufacturing or production or provision of any services at an SEZ unit. If you are any type of assessee who is doing what, sir? Manufacturing activity, or who is producing anything, or you are involved in providing services at an SEZ area, you can claim deduction under section 10AA. How much deduction can I claim? For first 5 years, whatever export profit you are earning into 100% you can claim. For the next 5 years, whatever export profit you are earning into 50% you can claim. For the last 5 years, you can claim 50% of export profit or amount credited to SEZ reinvestment reserve, whichever is less. Now, export profit is what, sir? Your total profit income of the your total business income of the SEZ unit into your export turnover divided by total turnover. What is export profit, sir? Whatever profit you have earned from that SEZ unit multiplied by your export profit divided by total profit. Export profit means what, sir? Amount received by you in convertible foreign currency within the due date specified by RBI. Now, while computing export profit, you should not include freight charges, telecommunication charges, expenses incurred for providing technical services, profit on sale of duty entitled passbook and duty drawback, etc. They should not be included. There are some questions with respect to deductions. Now, computation of total income, as anyways format to in your total income chapter, what is additional point which is there, sir? There is something called as 115 JC. This is called as alternate minimum tax. Please note, just like that we have something called as minimum alternate tax. Minimum alternate tax is for company. This is something they will ask you in final level. You don't have to break your head, okay? You don't have to break your head with respect to minimum alternative tax. At intermediate, at this inter level, what are they going to ask, sir? They are going to ask you about alternate minimum tax if they want to ask. Okay, 115 JC alternate minimum tax. All the assessors except company, because for company what is there, sir? Minimum alternative tax is there. For them also the rate is same. Whatever rate you are going to see, the rate is same for them also. But for them it is called as minimum alternative tax, MAT. Section 115 JC alternate minimum tax. It is applicable for all type of assessees except the company, meaning it is applicable for individual HUF, AOP, BOI, artificial judicial person, firm, LLP, etc. The tax which they have to pay is the tax calculated as per normal provision, which we did in our first class, or alternate minimum tax computed under 115 JC, whichever is higher. Now, what is this alternate minimum tax, sir? Alternate minimum tax is your adjusted total income into 18.5%. Whatever adjusted total income you have got into 18.5% is the alternate minimum tax. As I told you, there is something called as MAT for companies. For them also the rate is what, sir? Same. Now, please note, this is the amount of tax. Of course, you should add health and education cess surcharge if it is applicable. Now, sir, you said adjusted total income into 18.5%. Adjusted total income means what, sir? Or adjusted total income means your total income, add the deductions which you have claimed under section 80, 35 AD, 10 AA, 80 JJ, AA, 80 QQB, RRB, 80 IA series, etc., which is all coming in final levels. Okay, you will get your amount. From that you subtract depreciation on 35 AD asset. Because your deduction is added back, I will give you depreciation. I'll repeat once again. What is adjusted total income? Take your total income, whatever total income you have calculated. No, after your all the heads of income, subtract, etc., you'll get your total income. The total income, from the total income, add back what, sir? Deduction which is claimed under 35 AD, if any. Add back deduction claimed by you under 80 10 AA. Add back deduction under section 80 JJ, AA, QQB, RRB, 80 IA series, etc., I series. Add back all those deduction, you will get some amount. From this you subtract depreciation for the asset of 35 AD. 35 AD asset, because you have added 35 AD deduction back, you claim depreciation on those assets. Whatever is left over is called as your adjusted total income. Into 18.5% is your alternate minimum tax. The provision shall, alternate minimum provision shall not apply to an AOP, BOI, artificial judicial person if their adjusted total income does not exceed 20 lakh rupees, and assessee who pays the tax under 115 BAC. For these people, it is not applicable. So 2-3 questions I have solved. Now please note, what do you mean by alternate minimum tax? Meaning the tax which I have to pay normally. What is the tax which I have to pay? My normal tax or alternate minimum tax, whichever is higher. Correct? No. So if alternate minimum tax is higher, I'll pay alternate minimum tax. Now don't you think I was liable to pay only 19 rupees, but I paid 26 rupees. So can I say I paid extra 7 lakh rupees? 7 lakh rupees. That 7 rupees extra which I have paid is AMT credit. That is given to me as AMT credit. What is AMT credit? AMT credit is if the difference between alternate minimum tax and normal tax. AMT credit can be carried forwarded for 15 years. AMT credit can be utilized in the year in which normal tax is more than alternate minimum tax. It can be utilized to the extent of AMT credit available or difference between AMT credit and alternate minimum tax. Meaning whichever year if you have AMT credit, whichever year your normal tax is more than your alternate minimum tax, the difference of that will be allowed to you as AMT credit. I think 115 BSc already we have discussed, and comparative analysis also we have done. And I think this is something which we have discussed in our first topic. Yes, I think we have discussed. I don't know. I mean, anyways, I'll discuss it again, no problem. So 115 BSc is applicable to 115 BSc. You remember the default tax regime, new tax regime. That 115 BSc is applicable to an individual HUF, AOP, BOI, artificial judicial person. It is applicable to both resident and non-resident. See, normal provisions under optional regime or under old regime up to 2.5 lakhs, 3 lakhs or 5 lakhs, no tax is there. From 5 lakhs to 2.5 lakhs to 5 lakhs, 5%, 5 to 10, 20%, more than 10, 30%. But under 115 BSc up to 3 lakhs, no tax, 3 to 7, 5%, 7 to 10, 10%, 10 to 12, 15% more than 12 to 15, 20% more than 15, 30%. Surcharge is applicable if the total income is more than 50 lakhs. If it is 50 lakhs to 1 crore, 10%, 1 crore to 2 crores, 15%, 2 crores to 5 crores, 25%, and more than 5 crores, 37%. Similarly here, more than 50 lakhs up to 1 crores, 10%, more than 1 crore up to 2 crores, 15%, more than 2 crores, 25%. Now for dividend income, long-term capital gain under 111A, long-term capital, short-term capital gain under 111A and long-term capital gain under 112 and 112A, maximum surcharge is 15%. All these things we have discussed in our first video. You please go in detailed discussion. We have done. We have solved questions also. Health and education says 4% of tax will be levied, and rebate will be given up to 12,500 rupees in case of normal provisions and up to 25,000 in case of new regime. Now, if I follow 115 BSc, there are a lot of benefits which they are going to take from you if you opt for 115 BSc. In respective chapters we have discussed about that, but now we are discussing all those points consolidated now. Okay, exemptions or deduction not available if a person is opting for 115 BSc. Income from salary, following benefits will be taken away from you. It will not be available. What are these? Leave travel concession exempt under section 10(5) will no more be exempt. HRA exempt under section 1013A will now become taxable. If you follow 115 BSc, this benefit will not be given to you. Then allowances under section 1014, that is you cheat, duck hat, all those allowances will not be given except transport allowance to handicapped employee, traveling allowance, tour allowance, daily allowance. These allowances will be given. No deduction under section 16 for standard deduction. No deduction under section 16 except standard deduction. Standard deduction will be allowed for 150 BSc employee also up to how much, sir? 75,000. Then if you have an income from house property, then for SOP, interest will not be allowed as deduction under section 24B, and for DLOP and LOP it is same. And for business income, no additional depreciation, no deduction for donation to scientific research, no deduction for 35AD business, etc. Then capital gain, there is no change. Other sources, no exemption for clubbing of minor child income. MLA, MP, constituency allowance will be taxable. Family pension deduction is 1/3 of pension or 25,000 rupees extra deduction. From gross total income, no deduction will be allowed under gross total income, and also 10AA deduction will not be allowed under gross total income. Under deductions chapter, only 2 types of deductions will be allowed. Set off and carry forward of losses. Losses of current year cannot be adjusted with income of losses of house property of current year cannot be adjusted with income of any other heads. Then no set off of brought forward losses if the losses is because of above regions. And special rate income will be taxable at special rates. AMT provision shall not apply if a person is following 115 BSc. Now, advanced tax we'll see, then we'll take 5-10 minutes break and we'll continue with TDS TCS, which is our last point. Advanced tax, TDS, TCS, correct? See, normally what do we do? Whatever income you earn in previous year, you pay the tax in assessment year, correct? That is what you do normally. But however, this advanced tax provision says they follow a system called as pay as you go. Pay as you earn or pay as you go, meaning whatever income you are earning in previous year, pay tax also in previous year itself. Sir, how will I do that? They are telling During the year, estimate what is your total income. So for this year, like for example, now the 25-26 has started. So for the year 25-26, what is your expected? What for current year? Is it ended? 2026 is ended. See, 31st March 2025 is already over. So last year is already over. So current year is still running now. So for current year, what is your expectation? How much income are you going to earn in the current year? Estimate that and find the tax amount on that estimated income. You'll get some tax amount. On the tax amount, whatever tax is there, whatever tax is there, that you have to, that is called, that is the estimated tax on estimated total income. This you have to pay in 4 equal installment. So you estimate the total income and pay the tax on that. That estimated tax, whatever it comes, no, you should pay in 4 installment, which is by 15th of June, 15 September, 15 December, 15 March. These are the 4 installment: 15 June, 15 September, 15 December, 15 March. How much should I pay, sir? Whatever your estimated tax has come, 15% of that you should pay by 15th of June. 45% of that you should pay by 15th of September. 75% you should pay by 15th of December, and 100% you should pay by 15th of March. Now, so let us read some provision. Advance tax means the tax paid in the previous year. Advance tax is payable where the, see what is advance tax? Advance tax means all the taxes paid by you in the previous year is an advance tax. You will have to pay advance tax only if your advance tax liability is rupees 10,000 or more. Only if you have to, when is advance tax liability coming to you? Only if your advance tax amount is 10,000 rupees or more. In case of senior citizen who does not have a business income, he will have to pay advance tax. He does not have to pay advance tax. If you are a senior citizen who does not have any business income, for you advance tax provision shall not apply. And if you are a 44 AD or 44 ADA assessee, meaning if you are an assessee who is following presumptive system, you can pay full advance tax in one installment only, which is final installment, which is 15th of March. Then on these incomes, advance tax you will have to pay from the date when you started earning this income, because this income cannot be estimated. Advance tax on following income will be applicable from the date when these incomes are generated. Which are this income? Capital gain income, casual income, and income earned from business for the first time. Now, how to compute advance tax liability? This is important. See, step number 1, total income shall be estimated on the basis of tax regime you should follow. First, you should estimate your total income. Estimated total income, subtract your deductions, you will get your estimated gross total income, subtract deduction, you will get your estimated total income. So please note here, estimation should be done based on which regime you are following. Based on what, sir? What tax regime you are following. On that estimated total income, compute the tax amount. Tax, how will I compute, sir? Normally whatever tax due is there, you compute that. Add surcharge, health and education cess, you will get some money amount. From that, subtract TDS TCS credit, subtract whatever advance tax is already, subtract TDS TCS credit. Whatever is left over now is the advance tax liability. This you have to pay in 4 installments: 15 June, 15 September, 15 December, 15 March. 15%, 45%, 75%, 100%. So in this 4 installment, you will pay this money. In this 4 installment, you will pay this money. So there is one question which is there. I'll just discuss this question. Just discuss, okay. Dilip gives you the following information using which compute his advance tax liability. Total tax liability for the year is 3 lakhs. TDS deductible but not deducted. So they had to deduct the TDS but did not deduct. So can I subtract from my tax liability? No. TDS deducted but not remitted. So they have deducted the TDS but not paid to the government. That benefit also I cannot take. TDS deducted and paid to the government 80,000. This is the benefit which I can claim. So my tax liability is 3 lakh rupees. From that, this 80,000 rupees TDS I can subtract. What is my advance tax liability? 2,20,000. This advance tax liability of 2,20,000 I will have to pay in 4 installment. What is that 4 installment? 15 June, 15 September, 15 December, 15 March. 15%, 45%, 75%, and 100%. And whatever I have paid already in the previous stage, that will be subtracted. Yes, so this is all about your advance tax provision. Now what we are going to do, sir, we will take a short break of 10 minutes only. 10 minutes break I'll take, and we will discuss our TDS TCS provision. Okay, this TDS TCS is the last discussion, which will hardly take around maybe half an hour's time for us to discuss. We'll start the discussion with TDS and TDS in just 10 minutes. Okay, So you can wait for 10 minutes.
Welcome back, students. Welcome back. Let us discuss the last topic in our income tax, which is TDS, TCS. Very small topic, 2 minutes discussion. Okay, next maybe half an hour will complete this, or 20 minutes will complete this. Section 90 talks about TDS and advanced tax, tax deducted at source and advanced tax, and also TCS, etc. Income shall be assessed in the assessment year. However, the tax on such income shall be recovered in the previous itself. How will government recover the taxes? In the form of TDS, TCS, or advanced tax. Now, direct payment, if TDS is not deducted, you will have to directly pay the taxes to the government. Let us now come to the provisions of TDS. Now here there are some sections wherein the rate has been changed. Okay, those sections are little important, and there are this recharge A. These are the most important section under TDS. Recharge A 194, 194R, 194I, 194C, 194H, 194A, and 194J. These are those sections which are most important under TDS provisions. Apart from that, there are some changes made in some sections. There is a change in rate from 5% it is reduced to 2%, etc. Those sections will be important. Others, I mean, if you see TDS topic, no, it is very vast when compared to other topics, which is there. Lot of things are there to remember. So if you remember recharge and wherever changes are happening, then that will be good and sufficient for you. That will be good and sufficient for you. Section 192 talks about what's the TDS on salary. Can TDS be deducted on salary, sir? Yes, TDS is required to be deducted by employer whenever he is paying the salary to the employee. If the salary of the employee is more than the basic exemption limit of 2.5 lakhs, 5 lakhs, or 3 lakhs, depending upon what regime he is following. Then section 192A, if employee has whatever amount is there in employee provident fund, whenever the employee is withdrawing this money, if the withdrawal is more than 50,000 rupees, 10% TDS is required to be deducted. Then 193, interest on securities. If you have invested money in any securities, and if the person who is giving you interest, if the should deduct the TDS at 10%. TDS will not be deducted if the interest is not more than 5,000 rupees. Then TDS on dividend 194. Company who is giving dividend should deduct the TDS if they deduct the TDS at 10%. If the TDS amount is less than 5,000 rupees, no, sorry, if the dividend amount is less than 5,000 rupees, normally no TDS is required to be deducted, but no, normally every company will deduct TDS irrespective of the limit. Section 194A, I told richa, R, I, say, ha, cha, 194A. Interest other than interest on securities, important section. So this talks about interest on any loan given by you, interest other than interest on securities. So if you have taken any type of interest, if you have taken any if you are paying any type of interest, the person to whom you are paying that interest, you should deduct TDS at what rate, sir? 10%. So any person who should deduct, any person. Now please note one more thing about recharge A. What is one more thing about recharge J, sir? This TDS, recharge J, TDS is required to be deducted by any person other than individual and HUF. And individual and HUF will have to deduct TDS for these sections, recharge A, if their turnover or gross receipts is more than 1 crore rupees or 50 lakh rupees. Meaning, in simple words, the individual and HUF normally don't have to deduct TDS in case of recharge A, but individual and HUF will have to deduct the TDS in case of recharge A if their books of accounts are subject to audit. Okay, so the deductor will be who, sir? In case of recharge A, the deductor will be any person other than individual HUF. Any person means any person. No. Yeah, sir, but what do you mean by that? Company, firm, AOP, BOI, except individual and HUF. When will individual and HUF deduct TDS? If the turnover of individual HUF is more than 50 lakh rupees or 1 crore rupees. Meaning if their books of accounts are subject to audit. Okay, sir. Deductor is any person except individual and HUF, and individual HUF if their books of accounts are subject to audit under 44 AB. Now rate of deduction is 10%. Threshold limit 40,000 rupees. If you are paying interest, if interest is paid by bank or post office, the limit is 40,000. If interest is
in 50,000 rupees if it is the interest is paid to senior citizen, and in all other cases if I have taken money from someone and if I'm giving interest to him, if the interest is more than 5,000 rupees, I will have to deduct TDS provided my books of accounts are subject to audit because I am an individual. Okay, no, this section is not applicable wherever the partnership firm interest is paid to a partnership firm, or partnership firm is paying the interest to the partners, or you are paying the interest to central government, state government, or any interest is paid to any bank. You are taken loan from bank. Will you deduct interest? No, not required. Then 194B and BBA, important section. 194B and BBA talks about what, sir? Winning from lottery, gambling, casino, horse race, etc. Whoever is paying you the money, once you win lottery 50 lakh rupees you won, once you win the money, whatever amount you get, no, 30% of that is taxable. Hey, do you remember there is one there is one person story. A person in Kerala, no, in the state of Kerala, the lottery is still there. So in a person in Kerala won a lottery ticket worth one lottery worth rupees 10 crores. See the beauty of this person. Okay, his name starts with P. So he won a lottery worth rupees 10 crores. So when you win a lottery worth rupees 10 crores, what will happen? The company will not give you 10 crores. It will give only 7 crores to you. 30% of this amount will be deducted as TDS. How much, sir? 3 crores will be deducted at TDS. Only 7 crore rupees was given to this person. Now please note, what this person did, you know? With this 7 crores, he purchased land. What he purchased? He purchased land. And beauty, what land he purchased? Agricultural land he purchased. He purchased agricultural land. Of course, some commercial land also he would have purchased for residential purpose. Now he purchased agricultural land for doing agricultural activity, etc. Now, when he was doing this agricultural activity, when he was digging the ground, etc., making the land level, there he found two, what do you call, matka? What is that matka called? Two, two vessels. He found two vessels in which there were gold coins. And do you know how much worth gold coin they were? These gold coins were worth 2,550 crore rupees. These were how much worth, sir? 2,550 crore rupees. See the beauty. How lucky this person must be in his life. First, though, he is lucky because he won lottery. And that lottery, 7 crore rupees was also a huge amount for him. After winning that, when he purchased that land, from that land also, Maja only happened in his life. 2,250 crores. I mean, you can just see, nice person, nice life he has. Now, yeah, section 194 BB, section 194 BBA. So when you are winning any lottery or crossword puzzles, or you are going to any TV shows or horse race, you are betting, etc. If you are winning more than 10,000 rupees, the person who is paying the money to you will deduct a TDS at 30% flat. Sir, what if winnings are in kind, sir? What if winnings are in kind? Then the winning will be given to you only if you deposit the TDS amount. Then 194 BA, winning from online money games. Same online money games also, 30% TDS is required to be deducted on net winning amount, whatever amount you have won on that amount. Now here there is no threshold limit. Even 1 rupee you win, you will have the TDS will be deducted. 194C, Richa. 194C, payment to contractor and subcontractor. Any person, so here again see, who has to deduct? Any person other than individual HF, if their books of accounts are subject to audit. The rate of TDS is 1% in case the person who is giving the services to you as a contractor, if the contractor or subcontractor is an individual HF, it is 1%. If the contractor or subcontractor is any other person, then 2% is the rate of TDS. Here there is a limit of 30,000 for a single payment and 1 lakh rupees for multiple payments in a year, the total payments in a year. Now, this is the rate of TDS in case of what, sir? Contract. If you enter into any type of contract. And if insurance company is giving insurance commission, if the commission is more than 15,000 rupees, it should deduct TDS at 5% if it is giving money to resident, and 10% if it is giving the commission to a domestic company. Section 194 DA, payment in respect of life insurance policy. So if you remember, 1010D is applicable. 1010D means what, sir? life insurance policy, whatever amount you receive at the time of maturity, that is exempt under section 1010D. So now life insurance policy maturity amount which you receive, no, that on that amount they will deduct TDS at 5%. Now the rate has been, with effect from 1st October 2024, the rate has been reduced to 2%. Now if the amount is more than 1 lakh rupees, then only this provision is applicable. 194E, if you are a non-resident sports person or a sports association, for example, IPL is happening, many foreigners are coming from to India, and they are playing over here, they are earning money from India. Whenever payment is made to them, for that payment the company who is making them the payment, they should deduct TDS at 20% per annum plus cess of 4%. TDS is what, sir? 20% plus 4% cess, and surcharge also wherever applicable. 194EE, if you deposit the money to National Savings Scheme account, if the amount is more than 2,500, 10% TDS will be deducted, not a limit. 194G also not that important. In case of sale of lottery tickets, whatever commission is there on that, 5% TDS is deducted, and 2% with effect from 1st of October. If the amount is more than 15,000, then only this provision is applicable. 194H, important section. Here there is a change. TDS is required to be deducted by any person other than individual HUF, and individual HUF if books of accounts are subject to audit. TDS is required to be deducted if they are paying commission to any person who more than 15,000 rupees. TDS is deducted at the rate of 5% and 2% with effect from 1st of October 2024. If you are paying any rent, if the deductor is paying any rent, then the TDS is required to be deducted at 2% if they are paying the rent for plant, machinery and furniture, and at 10% if they are paying the rent for any land, building, furniture fittings. Plant, machinery and equipment, it is 2%. Land, building, furniture and furniture fitting, it is 10%. TDS, what is the limit for this, sir? The limit for this is 2,40,000 rupees, that is 20,000 rupees per month. 194 IA, if there is any sale of property happening, then 1% of transaction value or stamp duty value, whichever is higher, should be the TDS amount which is required to be deducted. If the sale value is more than 50 lakh rupees, the buyer will have to deduct the TDS. 194 IB, certain individuals, if they are taking any whose turnover is less than the limit, less than 1 crore or 50 lakh rupees, if they are what, sir, paying house rent of more than 50,000 rupees per month, then TDS is required to be deducted at 2% or 5%. 2% is from 1st of October 2024. These are all not that important. 194J, important section. Deductor can be individual HUF whose books of accounts are subject to audit, or any other person. Deductee is a resident assessee. 10% TDS is required to be deducted under 194J, and rate will be 2% in case you are making payment for technical services, royalty of cinematographic films, or for call centers. And the limit over here is 30,000. 30,000 is for each payment. So what are the different payments covered over here? Fee for technical services or professional charges, royalty, non-competing fee, and payment made by the company to its director. 194K, not that important section. 194K talks about what, sir? In case of specified units of mutual fund, administrator of specified undertaking, etc., 10% TDS is required to be deducted if the amount is more than 5,000 rupees. 194 LA, government is compulsory acquiring your property, not that important. If whenever government is giving the money to you, if the money is more than 2.5 lakhs, they will deduct 10% TDS and give the money to you. 194M, if an individual or an HUF takes any services from technical services, professional services, or subcontractor services, and if he's paying money more than 50 lakh rupees to him, then TDS is required at 5%. The rate has now been reduced to 2%. Important section because the rate is changed. If you are paying, say for example, I am doing interior designing of my house, and I have paid that person 60 lakh rupees. Lawmakers are telling, oh, you are a very rich person. 60 lakh rupees worth interior designing you are doing for your house means very rich person you are. Section 194N, payment of cash. Okay, so if you withdraw money from your bank, if the withdrawal is more than 1 crore rupees, 2% will be deducted at TDS. And if you are a person who is a defaulter, who has not filed your income tax return, then if it is more than 20 lakh rupees, then it will be 2%. More than 1 crore rupees, 5% will be the rate. So normally the rate is 2% of whatever amount you have withdrawn. Limit is 1 crore and 3 crores in case of cooperative societies. 194p, I mean, again, not important. If you are a specified senior citizen whose age is 75 years or more, and who does not have any income other than pension income and interest income, then bank will only compute their income and deduct the TDS and pay it to the government. Rate will be whatever slab rates are applicable. 194q, TDS on payment of purchase of goods. So if you purchase goods more than 50 lakh rupees, and if the payment is more than 50 lakh rupees in the year, and if your turnover is more than 10 crore rupees in the year, at the time when you are making the payment, you should deduct the taxes at 0.1% of sale exceeding 50 lakh rupees. 194R. So if any perquisites you have got in respect of your business, say I am doing business, I'm having electronic stores, I am selling goods of Samsung company, I'm selling goods of Sony company, I sold huge amount of goods of Sony company became very happy, they gave me a Mercedes car. Now this Mercedes cars is a perquisite which I received for my business because of my business purpose. Lawmaker says on this TDS is required to be deducted at 10%, because this perquisite is stated as business income. On that, TDS is required to be deducted at 10% if the value is more than 20,000 rupees. Section 195A, etc. All this, okay. This grossing up concept we have already studied. What will be your income, sir? After deducting TDS, whatever amount you have received, is that your income? No, your income should be grossed up. You should get your final, with including TDS, whatever amount is there, that will be your income. Then TDS is required to be okay. Whatever TDS is deducted is deemed to be treated as income of the assessee. Now, what is the due date of deducting the taxes, sir? The due date of paying the taxes are for the month of March it is 30th April, and for all the other months it is 7th of next month. Whatever TDS is deducted, that should be paid to the government within 7th of next month, and in case of March month it is 30th of March. And quarterly statement, once TDS is deducted, no quarterly statement is required to be filed for the last quarter. It is the due date is 31st of May, and for all other quarter 1, 2, 3, that is April to June, April to June, July to September, October to December, it is 31st of next month. Then TDS certificate is required to be given. For salary payments it is form 16, and for all other payments it is form 16A, which is required to be given by 15th of next financial year. Then what is the consequences if TDS is not deducted, sir? If TDS is late deducted, 1% is the interest which you have to pay for every month of delay or part thereof. If you have deducted but deposited late to the government, then 1.5% is the TDS. So if the PAN is not given, TDS will be deducted at a higher rate. So, and if a person is not filing income tax return, then TDS also will be deducted at higher rate, which is twice the rate applicable, or 5% rupees, 5%, whichever is higher. Then comes our TCS provision. TCS tax collected at source. Now, if you are purchasing goods like liquor, if you are purchasing a TCS on TCS by seller of certain goods. Which are these goods, sir? Liquor for alcoholic liquor for human consumption, tendu leaves, scrap, or timber for forest, any other produce, etc. TCS rates are these rates, not that much important. Sale. What is the rate for liquor, sir? But sir, not important, but still you tell it once, sir. For liquor it is 1%, for tendu leaves 5%, for scrap it is 1%, minerals 1%, 2.5% for any forest timber from forest lease, timber other than the forest timber, or any other forest produce, it is 2.5%. Sale or lease. So if you are taking a license of parking lot, or you are taking any parking lot on lease or toll plaza on lease, then TCS is required to be collected at 2%. Now, this is little important. If you are purchasing a motor vehicle whose value is more than 10 lakh rupees, then the person who is selling the motor vehicle will collect extra 1% from you as TCS. Then if you're going for a vacation, outside India, then if the total tour package is more than, if the total tour package is up to 7 lakh rupees, 5% is the TDS. If it is more than 7 lakh rupees, 20% is the TCS, which is required to be collected. If you have remitted money outside India more than 7 lakh rupees, then nothing, up to less than 7 lakh rupees, nothing is required deducted. However, if you are remitted the amount outside India for educational or medical purpose, then if it is more than 7 lakh rupees, then for first 7 lakhs, nothing is there. Then for any amount excess of 7 lakh rupees, 5%, meaning someone, say your child or your relative is staying outside India, now you are depositing money in his account for his education purpose. If you're depositing up to 7 lakh rupees, no problem. More than 7 lakh rupees, TCS at 5% will be collected. Then for any other purpose, if you're giving the money outside India, then up to 7 lakhs, no problem. More than 7 lakh, 20% will be the TCS applicable. Amount remitted out in education loan and aggregate amount for education. Amount remitted out is an educational loan. If the amount is an educational loan, then the rate will be 0.5%. Now, just like TDS we have in case of purchase of goods, just like that we have for sale of goods, we have TCS. If the goods sold by you is more than 50 lakh rupees in a year, TCS will be collected at 0.1% of consideration. Then if you don't give your PAN, then highest rate will be applied, or 5%, and twice. This is common point for both. Difference between TDS DCS not required. Advanced tax is something which we have already seen. Yeah, we have return filing. We have one more topic called as was, sir, filing of return of income. We have one more topic called as filing of return of income. Filing of income tax return. Now, who should compulsorily file the income tax return? If you're a company or a partnership firm, irrespective of whatever your turnover is, you should compulsorily file your income tax return. And for all other people, they should file their income tax return if their income is more than basic exemption limit, or they have deposited more than 1 crore in their current account, more than 50 lakh rupees in saving account. If they have made an expenditure more than 2 lakh rupees for foreign travel, if they have spent more than 1 lakh rupees for electricity bill, or if their turnover is more than 60 lakhs in case of business profession, it is more than 10 lakhs. Or if you are a beneficiary or beneficial owner of any asset located outside India. What is the due date of filing income tax returns? The due date of filing income tax return is for companies, etc., and those persons whose books of accounts are subject to audit, 31st of October. And if you are a partner of a firm whose books are subject to audit, for it is 31st of October. And if you are for you, transfer pricing provisions are applicable 30th November. For all types of people, it is 31st of July. All other type of people, 31st of July. Now, well, the total income for determining the due date of whether you should file your income tax return or not, you should exclude your deductions which you have claimed, exemptions which you have claimed under 54, and deductions under chapter 6A. Meaning, when you are taking your total income, no, exclude these items, and then if it is more than 2.5 lakhs or 5 lakhs or 3 lakhs, you should file your income tax return. Now, sir, when I'm making a loss, should I file my income tax return? Yes, you should file a loss return, because if you want to carry forward any losses, you will be able to carry forward only if you file your loss return. However, house property loss and unobserved depreciation can be carried forward without filing loss return also. Belated return, sir, can I, if I did not file the return within the due date of 31st July or 31st October, can I file it late? Yes, you can file it late, but you should file it before 3 months before the end of the relevant assessment year, or before completion of assessment, whichever is earlier. Sir, what if I file a return late, sir? If you file a return late, then you cannot carry forward losses. Then interest under 234A and late filing fees under 234F will be applicable. Revised return, can I revise the return? Yes. Once you file a return, that revise can be revised by you any number of times before 3 months before the end of relevant previous year, or 3 months or before completion of assessment, whichever is earlier. Updated return, a new concept has come into existence called as updated return. If you have not filed return for last 2 years or last 1 year, etc., now, or if you have already filed but shown less income, now you want to increase your income, you can file something called as updated return. No updated return. So updated return, a person who has filed or not original return or revised return or belated return can file an updated return within 24 months from the end of relevant assessment year. No updated return is allowed if when will updated return not be allowed to you? If the new return which you are filing, your tax liability is reducing. So when can the tax liability reduce? If the return of loss, updated return cannot be a return of loss. So first you filed a return of income, now you want to show loss, not possible. If it results in decreasing the tax liability, if it results in increasing refund amount, or it results in refund, any updated return is already submitted, you cannot file updated return two times, etc. Or where any assessment is pending, and such other persons as may be notified by the government. Defective return. See, once you file your return, what happens is automatically the system will verify whatever return details you have filed. Now the system by itself will tell you whether there is any mistake while filing the income tax return. This now those who are asking for the material, please see the first. Please see what, sir? Please see the first video. Everything is disclosed over there. Okay. Defective return. A assessing officer has the power to defective return. Yeah. So once you file your income tax return, once you file your income tax return, what will happen, sir? The system will verify for any defects, any mistakes are done by you. Once the system finds any mistake, it will give back that, it will intimate, it will give an intimation telling, please correct this defect. If you don't correct the defect within, 15 days, your return will be useless. It will be treated as invalid return. So charitable, political parties, and research association, universities, they are also required to file their income tax return. Their return is not that important. When they should file, sir, if their income is more than basic exemption limit, they all have to file their income tax return. Now, what is the tax which I have to pay on updated return? The tax which you have to pay on updated return is whatever tax is payable on updated return plus interest under 234 ABC and interest of whatever earlier tax return if you have not paid it, and you can take the benefit of whatever credits you have. Now, if assessee has not filed earlier return, if your assessee has already furnished earlier return, that is the option. If he has not filed earlier return, then whatever total tax is there in the updated return plus interest under 234 ABC, and your subtract your TDS TCS credit if you have any. Now, if you file the updated return within 12 months, 25% is the penalty which you have to pay. If you file it after 12 months, 50% is the penalty which you have to pay. Now, authorized person, who are authorized? See, once you file your return, no, that return is required to be signed by you. Now, who should sign this, sir? Individual should sign this return. For individual, for my return, who can do the authorization authentication? Individual himself, authorized representative, or guardian. For HUF Karta or any adult member, firm partner of the firm, and LLP, it is designated partner, company managing director, local authority principal officer, political party chief executive officer, and AOP principal officer. Section 140 talks about self-assessment. Self-assessment means what, sir? Whatever income tax you have to pay, you should compute your income tax by yourself based on the income which you have earned and pay the taxes to the government. Meaning, a person has to compute his own tax liability, taking into consideration all the income which is earned by him, all the TDS which is deducted, all the TCS which is collected, all the advance tax which is paid by him, whatever is left over, he should compute and pay to the government. So normally what this is, sir, under income tax law, assessment is self-assessment, where any tax is payable based on the return furnished under section 139 after considering the amount of taxes already paid, TDS, TCS, relief, EMT credit. The assessee shall pay such tax together with interest and late fees if applicable, of course, during delay in filing of return. You will have to pay your tax yourself. That is what this part. Order of adjustment of self-assessment tax. Now you have paid the taxes to the government. Now this tax is required to be adjusted. How it will be adjusted? First, it will be adjusted towards late filing fees, then towards interest, and then towards the tax which you have liable to pay. Yeah, then PAN related documents. Okay, PAN. Who should apply for PAN, sir? Any person whose income is more than basic exemption limit should apply for PAN before by 31st of May of assessment year. A person who has business income having a income more than whose turnover is more than 5 lakh rupees before end of financial year should apply for a PAN. If you are a resident who has done a financial transaction more than 2.5 lakhs before 31st of May, should apply for a PAN, and key managerial person should apply for PAN before 31st of May. Then PAN is required to be given whenever you if you deposit cash more than 20 lakh rupees in a financial year, and in 20 lakh rupees if you withdraw more than 20 lakh rupees in a financial year, and the current in current account the limit is actually 1 crore, and here the PAN is required to, you should apply for PAN within 7 days from the date when this transaction has been initiated. Now, which are the different cases wherein you should give the information about your PAN? If you purchase a motor vehicle, if you open a bank account, apply for debit card, credit card, open a deposit account, I mean, all these points are very general point. If you are paying a restaurant bill more than 50,000, foreign travel more than 50,000, mutual fund more than 50,000, okay, if you do any of such activities, no, you will have to give the PAN information to the government or that person. Then what if I don't give the PAN information, sir? 10,000 rupees is the penalty. Aadhar related information is also required to be given by you. So if you have section 139 AA mandatory quoting of Aadhar, you should compulsorily quote Aadhar wherever PAN is required to be quoted. There you can quote Aadhar instead of PAN. And while filing your income tax return, it is mandatory to quote your Aadhar. Quoting of Aadhar instead of PAN, wherever if your PAN is not allotted, instead of PAN you can give your Aadhar details. Linking of PAN and Aadhar is mandatory, or else you will have to pay a penalty of 1,000 rupees. Late, you will have to pay a penalty of how much, sir? 1,000 rupees. And if you don't link it, your PAN will become inoperative. You will not get TDS and TCS credit even if it is deducted. Now, before we had a concept of enrollment ID in Aadhar. Before, instead of Aadhar, you could have given enrollment ID, but with effect from 1st of October 2024, that enrollment ID concept has been removed. Authentication of Aadhar. Once you, I mean, see, authentication means what, sir? Once you link your PAN, no, an OTP will be sent to that number. Whenever you are filing your income tax return, you should sign that income tax return. Nowadays, that signing can be done through Aadhar. E-sign document through Aadhar can be done. Yeah, so wherever, see, same points which you studied under PAN. So if you deposit more than 20 lakh rupees, withdraw more than 20 lakh rupees in current account, etc. So in such cases, you are required to show your PAN. But if you don't have a PAN card, you can show your Aadhar card. Exemption from Aadhar linking. Who are not required to link Aadhar? Government, non-resident and foreign companies. Non-compliance of this section will give a default, for that penalty will be how much? 10,000 rupees. In case of Aadhar, the penalty is always 10,000 rupees. Okay, so that is all about this beautiful discussion. I think you have understood little bit of whatever we have discussed. Of course, there is some hard work which you will have to put from your side also. I expect you that you study very well. You study beautifully for your examination and complete your examination with great marks. Definitely come back and do comment on the on the comment section. You can please come back and give your feedback. That will definitely motivate me to make more and more videos like this. From Monday, I will be taking indirect taxes. I will try to complete in 2 days. If not, maximum 3 days, I'll complete indirect taxes. Or I'll do it 2 hours every day and complete in 3 days indirect taxes. And a little bit portion is there. Indirect taxes will happen soon. Yeah, so that is all from my side for the day. Thank you very much for being great audience and listening to me patiently. Let me meet you in my next video. Till then, tada, bye bye, take care. Enjoy, students. Happy learning. God bless you with all the success. Bye bye.